morning, everyone, or good afternoon, depending on where you are. The reason I chose this is the concept of a lost decade has sort of been a frequent topic in the financial news recently. And the term came into use in the 1990s after Japan's Nikkei index dropped about 50%. And it took 16 years for it to get back up to the original value. So that's actually more than a decade, but it was where this term was coined. My term for these periods is called a generational bear market. And it's not because they last a generation long, it's because they wipe out a whole generation of investors, or they so sour them that they never want to get back in and invest again. They just want to bury their money in the backyard or put it under the mattress. In fact, US investors have seen 5 generational bear markets in recent history. And this first slide shows the years 2000 to roughly 2013. The market peaked in 2000. It took it till 2013 before it rose back up above that original 2000 level and stayed there. This kind of a market is not just flat, drawn this line across here. It's marked by deep declines, strong recoveries, more deep declines, more strong recoveries. In each of these cases, an investor looking back over the period would see that at the end of the period, they didn't have any more money than they had at the very beginning of the period, assuming they were invested in index investments. Those kind of markets would have investors, especially income-oriented investors, thinking that they were in a big hole. Now, that's a technical term, big hole. But if you get the idea here, let me give you an example. Let's assume that someone starts in 2000 and they're drawing 4% a year out. 13 years later, they've withdrawn 52% of the principal, and they haven't really had any earnings to cushion that. So their portfolio might have dropped by as much as 52% during a market that was essentially flat. Okay, and this is the problem with these long-term generational bear markets. They're hard on investors that are trying to accumulate assets. They're very hard on people that are drawing income. The next slide shows the same kind of a market during the 1970s. Actually, we look here in 1968, and the market didn't, beyond that period, to stay there until 1982. Warren Buffett, in the next slide, has a really good quote. He said in 1964, the Dow Jones Industrial Average was at 874. 17 years later, in 1981, it was at 875. Now, I'm known as a patient guy. That's not my idea of a worthwhile holding. And I can't imagine anybody saying it better than Warren Buffett. The next slide shows us what happened during the 1930s. We had actually a 25-year period. The market peaked in 1929. We entered the Great Depression, and we had a significant decline, multi-year rally, significant decline, several years up, another significant decline. And it took quite a few years for it to get above that 1929 level. Some people say you shouldn't start counting till 1937 because the Depression was such an unusual period, but it still took 14 years to get back above the 1937 level and stay there. So again, long period of no returns. The next slide shows the early 1900s. From the peak in 1909, we had declines marked by rallies, maybe 6 months or a year in here, big decline, more rallies, declines, rallies, declines, rallies. So this period, if I remember correctly, had 6 different individual bear markets where the stock market dropped 20% or more. But you put it together and you had 16 years, you had to wait 16 years before the market broke above its level of 1909. And if we go back to the 1800s, this still continues. On the next slide, it shows a period from 1880 when the market peaked, didn't get back to that level till 1899. Again, lots of ups and downs along the way. It's not a flat market. And this goes back. During the Civil War, there was another lost decade. During the 1830s, when the railroad boom collapsed, there was a depression and another lost decade. In the early 1800s, the South Sea bubble that you may have heard about collapsed, and investors were underwater for 10 or 15 years there. So this is not a new phenomenon. This goes back a long time. And there are many periods where this has occurred. So we have to look at prospects for this current decline and wonder whether 2022 is setting us up for the start of another generational bear market. A generational bear market is a sequence of events rather than one thing going wrong like we had in COVID. That was a single event and we recovered from it fairly quickly. But clearly, if the market's already weakened by one event, there's a greater chance of another event bringing the market down further. And if there are risks coming from many directions, that means there's even more dominoes that might fall. And as for possible dominoes, there's many of them right now. Each of these items has showed increasing risk over the years and remain very concerning today. One is the use of leverage. It's very high right now. Last month, the British pension plans faced insolvency due to using leverage to buy British treasury bonds. They would make small down payments and borrow the rest of the money. And when the treasury bond market went down, their equity was wiped out and the lenders were demanding repayment because the pension funds didn't have the cash. They were forced to sell bonds, and it really sent the British treasury bond market into a downward spiral. That literally caused the British government to fail last month. That's why the woman, I can't even remember her name now, was forced out after just about 4 or 5 weeks running the government. I have a theory called there's never just one cockroach. And I watch for other debt defaults that may be the series of declines, which I think may be a hallmark of this next decade, is the world dealing with the surge of this tidal wave of debt that we've got. Just yesterday, a cryptocurrency exchange went bust and had to be bought out by a competitor. That may turn out to be another domino, but all of a sudden we have 2 cockroaches. And like I said, there's never just one cockroach. There's probably never just 2. Another item to be concerned about is stock valuations, such as price to earnings ratios, price to sales ratios. The markets still remain highly overvalued by historical standards. There's a lot more room to go down before they just can't go down anymore. The tech sector's been overheated. That's another concern, although we've been seeing a sort of a slow motion correction over the last 2 years. And of course, we have structural risk from inflation. And that may turn into what's called stagflation, something we haven't seen since the 1970s, which is the prospect of a recession and inflation at the same time. Interest rates are rising for the first time in recent memory, and many of these risks are more troubling because they're outside of our experience. Credit cycles and recessions are sort of normal for economists and people in the finance industry, but many of these we haven't seen, like inflation, we haven't seen since the 1970s. We haven't seen rising interest rates since 1982. Globalization is a relatively new phenomenon, and trying to unwind it so we have more manufacturing capability here, sort of a national security thing, has never been done before. And the impacts of climate change have no market precedent. So what's an investor to do when we're faced with the potential of a lost decade or a generational bear market unfolding in front of us? My opinion is the single best way to deal with this type of environment is through proactive investment management, like we practice here at Shadow Ridge. And that's because the markets never just go straight down. They have significant rallies as they're unfolding. And we have the ability to get out of the way when the market's going down and get back in and take advantage of at least some of the rallies and make a little bit of money when the rest of the world is losing their shirt. The trick is know when to get in and when to get out, when to hold them and when to fold them, as Kenny Rogers used to say. Proactive management can have you invested when the markets are strong, move to cash when the markets are weakening. And this is the only proven way, from what I know, to beat a generational bear market.